Hey traders, Gavin McMaster here from Options Trading IQ, and today we're going to be talking about selling put options for weekly income. Before we do, just a quick reminder that everything discussed is for educational purposes only, is general in nature and does not take into account your personal circumstances. Selling puts can be an excellent way to capitalize on strong stocks and build a robust portfolio. Whether you're new to options trading or looking to enhance your income generating strategies, this video will provide valuable insights and practical tips to help you succeed. So let's dive in and uncover the power of selling puts for weekly income. Understanding put options. Put options provide the holder with the right, but not the obligation, to sell a stock at a predetermined price within a specified time period. Put options are typically utilized by investors as a means of hedging downside risk or as speculative instruments to profit from price declines in a stock. When selling put options, traders assume the role of the option seller or writer. By selling a put option, the trader is obliged to purchase the stock at the strike price if the option is exercised by the option holder. In exchange for undertaking this obligation, the put seller receives a premium upfront from the buyer of the put option. The premium represents the compensation received by the put seller for accepting the risk of potential assignment. The premium value is determined by various factors, including the current price of the stock, the strike price, the time remaining, and implied volatility. Before selling put options, traders should carefully consider several important factors to ensure they are well informed and prepared to manage the associated risks effectively. Traders must evaluate their market outlook and sentiment regarding the stock to determine whether selling puts aligns with their trading objectives and risk tolerance. It's essential to conduct thorough fundamental and technical analysis of the stock to assess its intrinsic value, price trends, and potential support levels. Traders should establish clear risk management strategies, including defining maximum loss levels and implementing contingency plans for adverse market scenarios. Benefits of selling weekly puts. There's a high probability of profit. One of the primary advantages of selling puts for weekly income is the inherently high probability of profit associated with this strategy. Since the seller profits from the premium received up front, they can generate income provided the price of the stock remains above the strike price at expiration. Lower delta puts have a higher probability of success, but also a larger maximum loss level. Everything in options is a trade-off. Time decay advantage. Selling puts offers a distinct time decay advantage, particularly with weekly options contracts. As options approach expiration, their time value erodes rapidly, leading to a decline in the premium value. Time decay works in favor of put sellers, allowing them to capture profits from the diminishing value of the options contracts over time. Selecting the right stocks. When selling puts for weekly income, choosing the right underlying stocks is paramount to the success of the strategy. Traders should focus on stocks that exhibit certain characteristics conducive to option selling, such as liquidity, stability, and a consistent trading range. Try to stick to quality blue chip companies and ETFs and diversify across different sectors and asset classes. Selecting strike prices. Determining the strike price for selling puts requires careful consideration of various factors, including the desired risk-reward profile, market conditions, and the trader's outlook on the underlying stock's price movement. Optimal strike prices should strike a balance between generating attractive premium and mitigating downside risk. I usually like to go at around the 15 to 25 delta. Technical and fundamental analysis. Incorporating both technical and fundamental analysis techniques can provide valuable insights into stock selection and strike price determination when selling puts for weekly income. Stick with companies that are in strong uptrends and avoid the temptation of bottom fishing. Focus on companies with strong business prospects, solid earnings, and sales growth. Risk management. Implementing stop loss orders is a crucial risk management technique when selling puts for weekly income. These orders allow traders to establish predefined exit points to limit potential losses in their positions. Due to the bid-ask spread in option contracts, I prefer to set a price alert and then close the trade manually. Automated stop losses do not work well with options. Diversification. Diversification is another key risk management strategy that can help mitigate the impact of adverse events on a trader's overall portfolio. By spreading capital across multiple put-selling positions on different underlying stocks and sectors, traders can reduce the concentration risk associated with individual positions. Diversifying across different expiration dates and strike prices can further enhance risk management by reducing the correlation between positions. Position size. Maintaining appropriate position size and avoiding excessive leverage are essential aspects of effective risk management when selling puts for weekly income. Traders should carefully assess their risk tolerance and capital allocation constraints before entering any positions. It's crucial to avoid overcommitting capital to any single trade or taking on excessive leverage, as this can increase the potential for significant losses in the event of adverse market conditions. Let's take a look at a couple of examples. All right, so let's jump in and take a look at PLTR. What we're looking at here is a cash secured put trade, and it's for the first expiration after earnings. So we're selling the first strike out of the money. We're going to get $154 per contract for selling that spread or that option. And what we're looking at here is just the huge implied volatility because of that earnings announcement. We can see the implied vol on the stock is 74%, but the implied vol on this particular put option is up at 118%. So we're really using the uncertainty around earnings to our advantage to generate a huge amount of premium. Now, obviously, the risk is that the stock might have a big drop and we're going to end up in a loss situation if the stock drops below about 20.50. But that's a risk I'm willing to take in this case. And what I'll do, if the stock goes below 22, we get assigned, we take ownership of the shares. I'll sell covered calls against that position and just continue selling those calls up at around $22, $23 strike price until the shares eventually get called away. If it stays above 22, it expires worthless. We keep the premium and we're good to go. We can move on to the next stock. So I always like to plug the numbers into my little calculator here. It's an Excel calculator. If you don't have a copy of this, just reach out to me. But basically, we just need to fill in these cells in green. So the expiration dates, yeah, that's better. Stock price, $22.37. And the premium, let's say we get $1.50 for it. So we can see we've got a 8% margin for error on the downside and a potential almost 300% annualized return because we're generating a large amount of premium relative to the stock price in a short space of time. So it's a high risk trade because of earnings, and you don't achieve returns like this without having to accept some form of risk. So the risk, as you can see, it's a highly volatile stock. It could easily drop 10, 20% on earnings. So that is the risk that we're facing. Now, I want to compare that with a slightly longer term trade where if rather than choosing the first expiration after earnings, we were going to choose the June monthly expiration. The reason why I wouldn't choose this particular expiration, yes, we're generating a bit more premium, but we're only generating an extra $45 in premium, and we're having to wait an extra 6 or 7 weeks to get that extra $45. So it's not really worth it. And you can see here, the implied volatility isn't as high. So it's always the first expiration after earnings that has the biggest impact with that implied volatility. So we're getting the best bang for our buck with this short-term option. And I just wanted to show you why I wouldn't choose this particular one and I would go with this one. So one other risk with the trade is we've got some sell ratings by various analysts. So that's a little bit of a concern there as well. And it is a highly volatile stock. So just keep that in mind. And if we go over to Market Chameleon, we can get a look at what the stock has done over the past few earnings announcements. It's definitely had a couple of times when it's dropped 15, 20%. So a little bit of concern there. The last few have been relatively good or very good, in fact. So we'll see. Provided the stock doesn't drop by too much, we'll be okay. If it does drop, we'll take ownership. We'll self-cover calls against it until those shares get called away. Let's look at another example, this time on Walmart, where we can see another stock that's got earnings in the next week or so. So we're going for the next expiration straight after earnings, getting that higher volatility. We can see that volatility is up around 32% for that option compared to the stock, which has a general level of IV of 22. So we're getting good value for money with our IV. Again, generating about $100 in about 9 days. So that's a pretty good return. And I've added the June one in here again because there's really no point selling this one because it's the same strike price. We've got an extra month to wait and we're only generating an extra $40. So there's really no point trading that one. We'll trade that one, even though it's got the earnings risk. You can see here the volatility much lower at 20% as well. So we'll get rid of that one. Plug that into our calculator. And you can see much lower return than PLTR, but you'd expect that given that Walmart is a much more stable, low beta stock. The volatility is a lot lower. That's still a really attractive annualized return as well for potentially buying a quality company like Walmart for a 3% discount compared to where it's trading today. So that's definitely the type of trade I'll look at. We'll look at one more example, this time on Apple, which is a stock that has already reported earnings. So you can see here, the implied volatility is really low. So we're not really getting a lot of bang for our buck in terms of selling put options on Apple at the moment. Could still be an attractive strategy if you're happy to take ownership at 180, but you can see the capital at risk here is almost about 3 times larger than what we need for Walmart. If we have to buy the stock, we're going to need 18,000, whereas we only needed 6,000 in the Walmart example, and we're only generating $26 more in premium. So if we plug that into our calculator, our return in this example is going to be much lower. You see here our capital 5,900. Because we're trading Apple, it is a lot higher. See 17,875 capital at risk, and we're only generating a 25% return. Still a very attractive return. Most people would be happy with a 25% annualized return, but not as advantageous as using the earnings volatility to our advantage. So a few different examples there just to compare the risk and reward. Selling puts for weekly income can be a lucrative strategy for traders seeking consistent returns in the options market. By understanding the mechanics of put option selling, leveraging high probability setups, and implementing robust risk management strategies, traders can capitalize on the time decay of options to generate income on a regular basis. However, it's essential to approach put selling with caution and discipline, considering the inherent risks involved. By following the guidelines outlined in this video, traders can enhance their chances of success and build a sustainable income stream over the long term. Remember to continuously monitor market conditions, adjust strategies as needed, and stay disciplined in executing your trading plan. With proper knowledge, preparation, and risk management, selling puts for weekly income can become a valuable addition to your trading arsenal. Thanks for watching and have a great day.